5 ways to make your money work for you. If you don't want to work for money your entire life, you should probably learn how to make money work for you by ensuring that it grows passively over time. In this video, we will look at how to make your money work for you. To accomplish this, we will look at 5 practical steps you can take right away. 1. Embrace passive investing. It's time to start investing after you have saved enough for an emergency fund. Every step that has preceded you has been taken to get you here. Investing is the distinction between earning money and making money, your money doing the work from your own labor. Remember that understanding how to make money work for you has the advantage of generating compound returns over time. Investing is how money accomplishes this. Investing can be divided into 2 categories: passive investing and active investing. While the latter focuses on outperforming the market, getting higher returns, the former concentrates on tracking the market's performance, matching the returns of a given index. Active investors suffer higher fees and pay more taxes in order to outperform the market. Furthermore, they have typically failed to outperform indices, often lagging the market. Passive investors, on the other hand, seek to replicate market performance while benefiting from reduced fees, lower taxes, better diversification, risk is minimized and return is maximized, and greater transparency. Another advantage of passive investing is that it helps you conquer the great enemy of investors, your emotions. Instead of continually watching the market and making impulsive decisions, as is usual in active investing, you focus on the long term as your portfolio tracks the performance of the market. Warren Buffett was so confident in the superiority of passive investment over active investing that he bet $1 million in 2007 that the S&P 500 would outperform Protege Partners' collection of hedge funds over a decade. And he won the bet handsomely. 7.1% returns versus 2.2%. The amicable spectacle has come to represent the benefits of patience and passive investing. ETFs, exchange trade funds, are the preferred asset class for the passive investors. In essence, ETFs are low cost, very liquid. They trade on the stock exchange market like stocks and provide superior prospects for broad diversification, which is our next step. Rather than incurring excessive fees in an attempt to achieve high returns and failing, it is preferable to automate your investing by devoting 20% of your monthly income or more to a passively managed diversified portfolio. Furthermore, in order to gain from passive investing, you must invest for the long term. It's not how much money you make, but how money you maintain, how hard is work for you, and how many generations you keep it for, wrote Rich Dad, Poor Dad author Robert Kiyosaki. In other words, if you want your money to work for you, you must give it time to grow and reap the benefits of compound returns over time. The longer your money remains in the market, the more money you make and the less chance there is of losing it. Morningstar, a finance education and empowerment website, reviewed S&P 500 data between 1926 and 2019 and found that the longer you stay in the market, the higher your returns and the lower your risk of losing money. This is why, according to Buffett, if you're not willing your buy a stock for 40 years, don't even think about owning it for 10 minutes. 2. Create a diverse portfolio. To make your money work for you, invest in a passively managed fund, ETFs, over time. However, in addition to maintaining a long-term perspective, it is critical to ensure that the portfolio is appropriately diversified. What is the significance of diversification? When you put all of your eggs in one basket, losing that basket means losing all of your eggs. If you put your eggs in numerous baskets, the loss of one basket is less tragic. Investing is the same way. If you have all of your money in one asset, the loss of that asset will be catastrophic. However, if your money is spread over numerous assets, the loss of one will be less damaging. To reduce your risk, invest in a diverse portfolio that comprises a variety of assets that do not move in the same way. Assets that are not positively correlated. You can invest in several asset classes: stock, bonds, REITs, Bitcoin, markets, US, developed, emerging, market capitalizations, big, mid, and small, and industries, finance, health, consumers discretionary, etc. You must be diverse enough to survive terrible times or bad luck, so that skills and good procedure can have a change to pay off over the long term. Joel Greenblatt, co-founder of Gotham Funds, said of diversification. In fact, if you don't diversify, you're essentially throwing money away. According to Jeff Yass, co-founder of Susquehanna International Group, a trading and technology firm. Diversification can help you maximize your rewards while also lowering your risk. We investigated 3 portfolio types based on their level of diversification and discovered that the most diversified also generated the highest returns. The first in the S&P 500, which includes the 500 largest US stocks. The second is a mod-risk portfolio, which includes 40% US stocks, 30% global stocks, and 30% high-quality global bonds. And the third is a term mod-risk portfolio, which is globally diversified across multiple asset classes, including stocks, bonds, real estate, and commodities. As a result, the third, most diverse, outperformed the second, while the second exceeded the first. So, if the S&P 500 can provide you with an extra AED 20008 over a 10-year period, consider what a fully diversified portfolio can accomplish to reduce risk and maximize profits. You must invest in a broadly diversified portfolio for the long run if you want to understand how to make money work for you. 3. Make passive income. Earning passive income from your money is another method to make it work for you. Earning passive income is the easiest way to distinguish between making and earning money. The ability or aptitude to transform earned money into passive income and/or portfolio income is the key to financial freedom and tremendous wealth, remarked Robert Kiyosaki. Essentially, passive income is cash earned from labor done once and for all, requiring only little time and attention here and there. Investing in a passive fund, as should be obvious, is the primary and best strategy to make passive income. However, there are other ways to create passive income other from traditional investing, such as selling digital products, e.g., books, sources, apps, affiliate marketing, dropshipping, and content production, monetizing articles or video content. These passive income sources do involve some initial labor, as well as some maintenance work here and there, which distinguishes them from get-rich-quick scams. Their passivity stems from the fact that one step up, you may generate money from them even while sleeping. The money you spent setting them up continues to bring in additional money over time. Consider these passive income sources when learning how to make money work for you. 4. Stick to your financial plan. Discipline is required not only to invest for the long term, but also to keep to your financial strategy. If you know what you want, every time you invest in should be pushing you closer to it, said Tiffany Welka, a financial advisor at BFG Associates. Once you have defined your goals, step 1, and created a plan of action to attain them based on the previous steps, make sure you stick to it. Someone is always pushing the latest get-rich-quick scheme, dressed up with pleasant language, of course, or investment scam. These are always appealing because of the potential profits. But keep in mind that there is another side to every coin: danger. Many people lose money to these techniques because they ignore risk. Stick to your financial plan and be patient as you work toward your financial goals to avoid losing money. You need to keep raw, irrational emotion under control. Charlie Munger remarked above. 5. Make use of an online financial planner. Anyone who has invested previously will soon agree that one of the most significant barriers to money creation is our emotions. On the one hand, we don't want to lose money, but we also want it to increase as quickly as feasible. It's no surprise that Warren Buffett frequently says that temperament, not intellect, is the most important trait in an investor. As a result, when our emotions get the best of us, we frequently make terrible decisions. That is why, in order to learn how to make money work for you, you must first conquer your emotions. Using a computerized financial advisor is one method to avoid putting emotion ahead of logic. While a digital financial advisor is concerned about your money, they are not susceptible to the emotional roller coaster that so often leads to investment losses. A digital financial advisor will assist you in developing specific action plans to help you accomplish your financial objectives. Instead of focusing on what is happening in the market on a daily basis, they assist you in developing a long-term perspective. They can also assist you with retirement planning, investment planning, tax planning, and estate planning, among other things. Furthermore, unlike traditional financial advisors, digital financial advisors are more cost-effective and accessible, offering personalized answers to your specific situation. Thanks all guys! I hope you enjoyed watching this video. Remember to subscribe and give a thumbs up to this video. Thank you for your time.